Hi, everybody, and welcome back. In this segment, we're going to talk about the relationship between technology and cost. By technology, typically we're referring to the relationship between what you put into a productive process and what you get out. And in a moment, in fact, in the next segment, we're going to model that mathematically by using something known as a production function to capture the degree or the level of a technology that we have access to. The reason why we're going to investigate technology is because it's closely related to cost, and that's really going to be the focus of our analysis moving forward in the next few segments. Is we're going to analyze the cost structure of a firm, and technology and cost are really flip sides of the same coin. The reason why we are going to be doing this type of investigation is because we want to analyze the profit maximizing behavior of a competitive firm in a moment. And we're going to assume that the firm's goal is to maximize profit. The firm is a financial optimizer in that they're trying to maximize the difference between the total revenues they collect from the sale of the product minus the total cost associated with furnishing that product to market, which typically includes the value of all the inputs that a firm uses in the productive process. Now, we know from an earlier discussion that costs can be somewhat abstract. We can have explicit costs, which are not abstract, that require an outlay of cash. There's actual money being spent. So when you pay your workers wages, there's a cash outlay. But we also have implied costs, okay, which do not require a cash outlay. Things like the opportunity cost of time would be an example of an implicit cost. Okay, and one of the key ideas we had talked about earlier is that the cost of something is really tied to what you give up to get it. The cost of any decision is defined by the alternatives that you do not choose, specifically the best alternative. Now, this is true whether or not costs are implicit or explicit. Okay, both matter to a firm's decisions. Okay, so the full cost of a decision, we're looking at the sum of both the implicit and explicit costs. Now, this is relevant when we think about calculating profit because typically, from an accountant's perspective, okay, we do not really look at implied costs because they're hard to measure. So an accountant, they can measure the amount of sales pretty easily, so they can calculate total revenues. And they can also measure your explicit cash outlays fairly easily as well. So when an accountant calculates profit, they take total revenue minus only the total explicit costs, but they do not account for implicit costs, which are a little bit more abstract. Okay, economists, on the other hand, are a little bit better at thinking about the full cost of a decision. So when an economist calculates profit, they're taking the same total revenue, they're subtracting out the explicit costs just like the accountant, but they will also subtract out the implicit costs. Okay? And you always have some implicit cost of making a decision. Any decision, even if it's between A and B, you choose A. Well, your implicit cost is that you've given up B. So implicit costs are never zero. There's always some implicit cost, meaning accounting profit is higher than economic profit. Okay, from an accountant's perspective, the operation is always going to look like it's doing a little bit better in terms of profitability because the accountant is not subtracting out those implied costs. Okay, so we're going to pick up in the next segment talking about production functions. Hope to see you then.